Are you self-employed and trying to figure out whether a simple IRA, SEP IRA, or solo 401k makes the most sense? Hi, this is Huang Lei, CFP and EA in California. This video will explain the differences, the contribution rules, and the key deadlines that business owners cannot afford to miss. A simple IRA is usually designed for small employers that want an easy plan with employee salary deferrals plus a required employer contribution, either a match or a non-elective contribution. A SEP IRA is funded only by the employer, which makes it simple to administer, and contributions are generally made by the business tax filing deadline, including extensions. A solo 401k is generally the best fit for an owner-only business, or an owner and spouse, because it allows both employee deferrals and employer contributions and often creates the highest savings opportunity. Here is the practical difference. Simple IRA plans are easier than a full 401k, but they have lower contribution ceilings and mandatory employer funding rules. SEP IRAs are simple and flexible, especially for taxpayers who want to decide on the contribution closer to filing season. But they can become expensive if the owner has eligible employees, because the same contribution percentage generally must be given to those employees. Solo 401k plans usually offer the highest contribution potential because the owner may contribute as both employee and employer, subject to annual IRS limits. Now the deadlines. For a simple IRA, the plan generally must be established between January 1st and October 1st to be effective for that year. Employee salary deferrals generally must be deposited no later than 30 days after the end of the month in which they otherwise would have been paid. Employer contributions for a simple IRA are generally due by the employer's tax filing deadline, including extensions. For a SEP IRA, the account can generally be opened as late as the employer's tax filing deadline, including extensions for that tax year. SEP IRA contributions are also generally due by that same tax filing deadline, including extensions. For a solo 401k, the plan generally must be established by December 31st of the tax year if the owner wants to make employee deferrals for that year. The employee deferral election generally must be made by year-end, while employer contributions can usually be made up to the business tax filing deadline, including extensions. To sum it up, if the business is owner-only and the client wants maximum retirement savings, a solo 401k is often the strongest option. If the client wants simplicity and late filing season flexibility, a SEP IRA can be very attractive. If the client has employees and wants a lighter plan design than a traditional 401k, a simple IRA may be a workable middle ground. If you enjoy this video, don't forget to like, comment, subscribe, and turn on the notification bell to not miss out on my next videos.